Next question, actually, Ellis, I'm going to ask you because this kind of is a good one based on what you were just talking about. How do you evaluate the price of an opportunity when there aren't any comps? I mean, all you guys are dealing with kind of non-traditional stuff. So if you can't pull a set of comps, how do you evaluate the notes that you get?
I evaluate it in a couple of ways. Number one, what the range of cash flow that I can get from that investment, and the variability of the likelihood that I'm going to get it. So and then I want to also find out what is the bottom line, what I call the crash and burn. If everything goes wrong, what's going to happen? So if I buy a note for say $50,000, and the property is worth $100,000, I could quick sale it for $70,000. I'm okay with that, right?
How do you know it's worth $100,000?
Without any comps?
Or with comps, or without comps, or?
Well, it's kind of the basics. All my appraisers, right, say it's income approach, replacement approach, right, or comps. So if you don't have comparables, you look at replacement cost, and then you look at what's the ability of this asset to create income. That's really my fault. Mm-hmm. One of the flaws that I see in a lot of investors, and I made this mistake, is you say, well, here's this building, it's worth $600, and today you can get it for $300. That makes no sense to me. Because if that building is empty for the next 5 years, you got nothing, right? So I look at it as what kind of cash flow I can get from it, and do I have the expertise in order to generate that cash flow out of that asset, and I'll base it on that, the predictability of that income.
Okay. And it's actually, in this kind of a market, you brought up a point where, with no comps, there's a lot of properties right now in this kind of a market that don't have comps. So if your exit strategy is to sell that property, you can't buy it. And a lot of people think, oh, well, you know, hey, this property had comps that, they're a year old, but no, it's worth this, I'm positive. The appraiser's not going to think that way for the bank. Yeah, and don't correct me if I'm wrong here, but typically, yeah, go ahead.
I don't look at the different levels. Okay, if I screw up and I can't get this person to recast the loan or to work out the loan, and I foreclose on them and it costs me X amount of dollars, then I got to turn it into a rental. How much at the end of the day am I into this property, and what's my yield if I turn it into a rental?
Yeah, what's your downside risk if you don't have a plan, go to plan.
And if I can't turn it into a rental, there's not, a whole lot of exits left. So, I'm usually not buying where I could at least turn it into a rental. Yeah.
So some of these non-performing notes have got to be in like really decimated real estate areas.
Not necessarily. Okay. We bought one in Garden Grove, not a ghost town.
Okay. So like some markets, are you staying away from some markets because of vacancies?
Yeah.
Okay.
Yeah. I mean, there's a saying in the note business that there's no bad notes, only bad pricing. But there's a certain amount of work that's involved with tougher neighborhoods, tougher property, just like with rentals. And you have to say, okay, do I really want to buy this $8,000 note in Flint, Michigan, right? When I have to put all this work in, then what am I going to get out of it? A whopping few $1,000s profit with all this headache. I'd rather go buy something that's more worth my time. It's not as what we call doesn't have as much hair on it.
And when you're buying those notes too, I mean, everything's the collateral. So
it's
how are you not going to lose your money?
Right.
It's that collateral. So if you're buying in Detroit or something like that, or at a place that may not be the nicest place in the world, is that property going to be vandalized? Is it in a horrible location where you're not going to be able to go and check out and see if there's a rehab that you need to do on it? So don't buy in the hood when it's like that. So
yeah, my probably the lowest level of exit strategy I have is, okay, the house burns down, I got a piece of dirt, can I put a mobile home on it? If I can do that, I'm still running the numbers.
Cool. Ginger, I'm going to turn it over to you next. How do you evaluate when you're looking at a deal and you're trying to wholesale it out?
I get that too. A lot of people say, oh, it was worth $600 2 years ago, and now it was $300. And I said, well, what's it worth today? And as a wholesaler, I mean, your rehabbers and your buyers will hold your feet to that buyer. They will question every comp, like, why did you put that comp there? So you become an expert, and I would suggest start small and know one area, because you really need to know an area. Just because it's like 0.5 miles away or less than half a mile away doesn't mean it's a comp. We had one in Santa Ana where it was on, I don't know if you're familiar with Santa Ana, it was a Main Street. One side has like $1 million homes, and the other side not $1 million homes. So people are like, oh, this home is worth $1 million, you know? I'm like, no, it's not on the right side of the street. So you really have to know your areas. And if you don't, you have to drive them, get an appraiser, somebody in that area. And again, your buyers are, you know, they'll say, oh, we need a property in, you know, LA, you know, a certain part. So, you know, they'll tell you where to get comps or who to call. So your buyers are actually your own mentors there. But yeah, comps, especially right now, the market is very wobbly. I've been noticing it for a little while. Before it was pretty flat for a long time. Probably all last year it's kind of flat. So you're pretty safe going out 6 months. Now I don't go back 6 months. I'm doing like 2 or 3 months back now when I'm doing my comps. Because you have to be really tight right now for what the comps are doing.
Yeah, and if you're wholesaling a property off or buying it, rehabbing it, and selling it, you want to make sure those comps are going to be there when you go and try to sell that property afterwards. You got a question, son?
When you're comping and you are in a shady area, but you get a handful of comps, will you ever do a price per square foot comp on a property that you know will perform?
I hardly ever price it like that. If I'm not sure what I'll do, I'll call an agent in the area and I say, look, this is what, but not just one agent. I'll call like 5 of them and try to get like everybody's opinion on it.
Okay.
Yeah, that's what I'll do. But then ultimately, your buyers will also do their comps, and usually your buyers are specialized in one area. So I always follow up with them and say, what do you think the comp was? You know, did I get my numbers right? And they'll tell you, yeah, you did, I know you did it. And never ever inflate your comps because your reputation as a wholesaler is all based on how good you do your work. And if you just inflate the salad, they'll never come back.
Yeah, definitely.
Mm-hmm.
Yeah, I guess I'll answer it a little different way. But the way that I invest, I have basically 2 risks. The first is the asset or the investment, meaning I have to try to get my arms around what I'm investing in and whether someone's overpaying or underpaying for it. But the other risk I have is actually on the operator, which means also how they're structuring it. So the person who's managing the opportunity. And you know, if you're not used to hearing about passive or not used to thinking about it, you know, if you look at mutual funds, when you invest in a mutual fund, all you're doing is investing in a mutual fund manager who's then going to pick stocks and are an expert in that vertical. So I like to say, you know, I invested, for example, in 2008 and 2009 with a student housing syndicator who had done, I think, 15 different student housing multifamily opportunities. So I'm counting on that person to understand location, to understand what it really costs to run a building like that. And I'm doing my double checking, and once you look at enough deals, you know what to look for. But you are actually hiring an expert in that field in the way that I invest, so it's a little bit different. But at the end of the day, my check is really, how is the deal structured? Is it structured in more favorably or less favorable for investors compared to other managed opportunities I see? Those are my comps. It's actually looking at enough deals to understand how they're structured, whether someone is giving an investor a fair structure or not a fair structure. And another, you have to start looking even further and filtering further into how it's structured in many different ways. So it's a very different type of approach for me.
That's a really key point Jerry made there. That's actually something I've learned a lot from him about, is when you look at a deal, any type of deal, when you look at one, you look at the numbers, you're like, yeah, it looks pretty good. I mean, yeah, it looks fine. You really only know whether it's good until you start looking at 10 of them. And when you can really start comparing them side by side, that's where you can say, okay, wait a minute, this one's crap, this one's good, because A, look how this particular operator evaluated this particular element of the deal, or B, look how this particular operator did it. So it's important to look at a lot of deals as an investor. You have to, part of your education is constantly looking at things, looking at different types of structures, and when you find something you like, look at a range of it, because it's not until once you see a range of it, that's where you can start to figure out what you think it's worth, not what they think it's worth.
So guys, keep in mind too, so Ellis and Ginger are primarily looking at the assets in themselves for a particular investment. Jeremy's looking at, the operator, what is their experience, how do they evaluate their estimates on all of their stuff, how's the structure going on the deal. These guys look at the same thing, but Jeremy's coming from a passive investor standpoint. These guys are being a little bit more active and actively involved in being operators, where Jeremy will invest with an operator like them. So you see there's a difference. Jeremy's going to go do background checks and criminal checks on his operators, go out, check out the operation, look at all the estimates and see how it can be structured for performance. These guys are going to go through and look at what is my collateral for this deal, how fast can I move it, are the numbers right, let me get all my homework done on each individual deal that I'm doing, and that type of thing, which is a totally different I mean, it's not 100% different mindset, but you want to be able to look at each deal the way you're investing and approach it from that standpoint. So,
yeah, because I've done a couple syndicated deals, and you really are, what Jeremy said, you're really hitching your wagon to the strength of that operator. And I know one thing that I learned going through that experience working with an operator is that I'm too much of a control freak. That I don't think I'm well suited for that type of deal, because I would always find, why aren't they doing this or why aren't they doing that? And the downside is if that operator, if there's a hiccup, and that's why it's so important to do background checks and make sure they're
got a good system, yeah.
Right, but even then, think to fall is what do you have at the end of the day if everything falls out? That's why from now on, my personal choice is I want to have everything secured.
Yeah.
So that if I owned a share in XYZ limited partnership, and then they decide to do something that I'm not happy with, and I'm a 1% partner, I'm insignificant, right? But if I have a 51% interest of that, or if I have an actual, my actual entity owns that property, or I have a lien against that property, I have that kind of safety net. So.
I'm the same way with you on that stuff. Just because I'm an operator and I want to control it,
right.
What Jeremy does is a little different, is that he'll take small chunks of money and invest it across multiple assets so he minimizes his risk there, even if he's done all his homework on the asset, right? I mean, that's for the most part, I would assume.
Yeah, and so for me, actually, I trade control for diversification. It's actually really that simple. And my goal is to be able to go to sleep at night knowing that if one operator blows up and we couldn't get the asset back and something really goes wrong, that I've diversified so broadly that it really not going to have a major impact.
I'm glad you brought that up. So if that is okay with you, I would suggest that you diversify properly to mitigate that.
Yeah, and you really want to be properly diversified. It takes a long time. I like to tell people that if somebody in the room has $20 million and they want to invest it tomorrow passively, it's not going to happen. It's going to take a year or two, in some cases more, if you want to be really careful and you want to do it properly and you want to be properly diversified. It's a slow and steady approach, which is what I'm personally doing.
It takes a lot of education, definitely. So. Yeah.
So I mean, I've been doing it 10 years now, so it's a cumulative thing, and it starts to really pay off, and then you get compounding and all kinds of other things. But it's really a slow and steady type of approach.
Does anybody else in the room here have ideas as far as different ways that they evaluate deals, or different knowledge bases that they can bring to the table? I'm looking at Rick. Come on, Rick. Say something.
I don't know what to say. I mean, you call on different people for different things. I mean,
just to do your homework.
Deal, there's various sources you can go to, and the people that are right there. I hate using this phrase, but well, anyway, the whole boots on the ground thing. People that are in the area are very, very important. And one thing you said, Ginger, really caught my ear is it's so true in LA and probably in most cities is that. You can't look at a map and say, well, there's a house that costs this much, and this one's, 3 blocks. I mean, I live in North Redondo. Okay, my house 4 blocks away in Manhattan Beach is not worth the same amount. Not close. I mean, it's like half again as much. And so you have to, if you're out looking at a property you're going to buy, you have to go in the neighborhood.
And get those team members in place that know that neighborhood, or get the knowledge base that you don't have. That's cool.
All right, next question. Ginger, I'm going to ask this one to you first. What's escrow look like for your deal? So when you find an investment and you're actually going to physically purchase it or lock it down, what is that process like for you?
So escrow for me, they're getting a little bit tricky now. For example, we just closed one last week with Bank of America, and they have a deed restriction where I can't even quick claim my interest in the property to somebody else. That's how I was wholesaling some of these bank-owned properties. So I technically wholesaled it. I gave them a quick claim deed. They can't file it for 60 days, so I own the property. So it has a lot of trust, because that's pretty much, they gave me money to keep the property in my name. So it takes a lot of trust to build that. So some REOs, if you're just starting, I would just stay away from right now, Bank of America being one of them. But just a regular REO transaction, which I'm getting a lot of right now, I do simultaneous closings, which means my investor comes in with the funds on one escrow, and then that escrow funds my Bank of America or REO escrow, and I get paid on this other escrow. This closes, gets recorded. When that's recorded, then this one opens, buys it, and records, and I get paid. They get their profit. So I know it's kind of, I need a diagram. You have something? But basically, I'm doing a lot of REOs right now. But if it's a straight standard sale, I get it under contract, open escrow with my contract, find a buyer for it, they give me their assignment fee. In escrow, I do an assignment contract, and they close, and I get my money.
Have you found a way to get over the hurdle of wholesale and a short sale?
Yeah, we could do simultaneous closings too.
They're still allowing that?
Yeah. Actually, they stopped for a long time. They just started doing it again a few months ago. So the Lateral title companies would not allow it. So I would have to close first and then sell it. So I was doing that for a while, and I wasn't using transactional funding. I was using my rehabbers. I have a huge list. I said, who wants to make a couple of $1,000 for lending me money for a week? Oh my goodness, I got so many people like, here. Right? So I would just close it, and then they get paid, and everything's fine.
Would you have a buyer lined up before you locked it down?
When I first started, I did it, and I was like, what's going on? Why can't I sell it? So I just did a survey of my buyers. I was getting them the wrong stuff, and that's why they weren't buying. So now I know my buyers really well, so I know what they'll like. So I know if I can get it at this price, at this margin, in this area, I know they'll sell.
I tell you, that's key. I mean, from anyone who's done any marketing, the most important thing when you market is to know what your clients are looking for. You can't do something and force it on your clients. You got to figure out your clients and then serve them what they're looking to buy. So that's really key insight.
Buyer, if you're looking to wholesale, find, and here there's a lot of rehabbers. What are they looking for? Go find it for them. Just go find it for them.
So you're working with a group of rehabbers rather than
rehabbers and landlords. I have half and half. So some properties I know people will hold for cash flow, so I look for those too. So I have, but right now most of them are rehabbing.
Cool. Ellis?
What does escrow look like? When you're doing a note transaction, it's really kind of strange. A lot of times it's just really on relationships. We'll wire over like $300,000, $400,000, and they'll say, okay, we're going to get you these loans. And you wait, and then stuff kind of dribbles in, and then after a while you have all your loan package. Sometimes it's very efficient, they get it over quickly, sometimes they don't. When I'm buying it from a private party, I just got a property that for, those seminars that say no money down? Well, I actually got one.
Nice.
No money down, they sent me the deed. And I was like, cool. So it really depends. When it's institutional, it's much more formalized. When it's private party, it's kind of like the Wild West. But when I'm buying property, kind of like Ginger's doing, it's more kind of traditional. Do the whole traditional escrow thing.
So you actually trust the banks with your money? Like
well, we work a lot with hedge funds.
Okay.
So we have long-standing relationships.
Good,
There's
good,
not
okay.
a whole lot,
After you've done a bunch of them, you're okay. Yeah.
Right. But
How long does it take usually?
it depends on who you're buying from. I've had a situation where we bought a portfolio of say 30 loans, and we get 10 right away, and then a couple other dribble in, and then like 6 months later, the last 2 loans drop in, and we're like, oh, what's going on? It's because when you're buying, everybody knows what's going on with the banks and what a mess up they, with all the takeovers and where's the paperwork. So if Bank of America doesn't record correctly and they don't know where this document is, it has to get all sorted out, and then finally gets to you. Yeah, and then finally it gets to you, and then now you can work on it. So.
How does it go with the paperwork when you're actually closing a note on, when you're acquiring, maybe just say
From a
one
bank?
note, yeah, from a bank versus a private party?
So from a bank, what will happen is they'll send you out a list of notes available for sale. You bid on them, and when you have a price that you agree on, they send you a purchase and sale agreement. XYZ Ventures agree to buy this for this price, and then they give you the wiring instructions. You wire over. They send you what's called a collateral package, which has all the documents associated with that loan, and then you go to town.
Okay. And what are the major differences between that and when you're getting from a private party?
With private party, I get to dictate a lot of the terms depending on who I'm dealing with.
Okay.
I was just talking to somebody about, I bought a note in Paso Robles, one of my first notes. The note holder said, it was Christmas Eve, and I said, well, if I can get there it was the day before Christmas Eve, I said, if I can get there in 24 hours, will you sell me the note? I have the money right now. He said, yeah. So I got on a plane, went to Paso Robles. We met at a bank, and then switched paperwork assignments and everything, and then we said, well, we need a notary. good luck finding a notary on Christmas Eve. So we're walking down Main Street in Paso Robles. We find a title company, and they're having a Christmas party, so everybody's lit. And I was like, hey, we need a notary, we need a notary. And I'm like, okay. And, you know, that's why I do private notes, is because it's a better story. It's all over the board with private notes.
That's great. Jeremy?
Closing
I invest
escrow.
in so many different things.
Yeah.
And
Give us the real estate type of, like, more of your structured real estate deals, what that escrow process looks like.
which kind of real estate?
Especially from a managed real estate, bigger piece of
Syndication.
property, syndication,
Like the student housing, maybe.
Syndicate, all right.
student housing,
So
or
typical
Bridgewater.
Typical syndication, like say commercial property, usually those types of properties are, you know, figure $5 to $20 million purchase. The operators typically negotiated usually between 3-4 months to actually do their due diligence and actually close on the deal. So within the first month, they'll actually start some preliminary due diligence. They'll get a really good sense of whether they really want to close on or not. They might put some money into escrow to actually take the property into escrow to begin with. And then they're typically looking for investors for 2-3 months. And when I received the opportunity, I'm assuming other investors are receiving it as well. And then it's just a question of, okay, are they going to full oversubscribed or not? That type of situation. There are cases where if they don't find enough investors, they won't close. But to be honest, I hardly ever encounter that, because the people I'm working with are typically so experienced that if they can't find enough investors, they actually take the rest of it themselves and just backfill it after, because they want to get the deal done because it's a good deal. So basically an escrow process for me is literally just funding either escrow and or directly into an LLC to be able to close on the deal. And typically you're not funding, typically once you fund into a deal like that, the good point is that it's typically not closing for another month or so until after you fund it. Because they're not waiting until the last minute.
And everyone funds right on time, right?
Always on time, yeah. No, what they do is a typical operator will actually tell the investors that there is a due date of, call it January 31st, when in reality they're really not going to close until the end of February. So that people are straggling in, they'll give themselves a week or two for that padding. So they're not going to do that to themselves. They're very careful with that.
And each type of syndication has a different funding amount, like as far as a minimum. Some of them, if they're big funds, they may have to only have accredited investors involved, which means that they're going to make $200,000 a year or have over $1 million in net worth. I think it's excluding their primary residence, which means you can't just have all your money in your house and think it's still worth what it was 10 years ago. You know? And then what about the paperwork associated with that? You're talking about a PPM. What other paperwork is involved?
Okay, so typically as an investor, I'm filling out a subscription agreement, which is essentially, depending on how it's structured, but let's say for the type of thing that you're thinking of, a larger deal where there's a really big pool of investors, you're filling in subscription, you're actually telling them the level of experience you have in investing. They're asking you whether or not you're accredited. In most of the opportunities I invest, you do not need to be an accredited investor, but there are some exceptions. And so you are actually divulging some personal information. They need to get often your social security number, because you have to be registered in the LLC for the K-1 taxes and everything else. You can invest through an entity if you want, but then you need what is it called again? TIN?
EIN.
EIN, thank you. I'm from Canada originally, so. You're basically submitting that plus a check, and I'm trying to think if there's missing anything else. Sometimes there's a separate questionnaire. There's 2 questionnaires. Sometimes there's one. It depends on how the opportunity is. The subscription agreement, and there's another questionnaire besides that. Depends. But you're basically filling out paperwork to be part of typically a company or an LLC, and you're sending in a check along with the paperwork. They actually have the right not to accept you based on what you put in, based on whether they need more funds, and they always reserve that right. And like Matt said, the minimum investments or type of investments just all across the board. So.
But before you take that, can you explain what an accredited investor means?
Yeah, an accredited investor is, and this only applies to U.S. residents, an accredited investor either has made for the past 2 years, and I'm not a financial advisor, so I think I have this right, but just in case. They have, typically accredited investor requirement is that if you're single, you have to have made at least $200,000 for the past 2 years and expect to make $200,000 or more this year, or if you're married, you have to have made at least $300,000 for the past 2 years and expect to make $300,000 this year, or you can have $1 million net worth or more. It could be one or the other. The $1 million, like Matt said, I think last year or the year before they changed. It used to be including your home equity and your primary residence. Now it's excluding. Foreign investors, actually, or foreign entities, are completely exempt from being accredited investors. So if you're a foreign investor, you don't have to be accredited in the U.S.
And the reason for that is, the reason why they have that in place is because if something goes wrong with the investment, the judge can say, hey, look, you knew what you were doing. You're a high net worth investor. You should have looked at the paperwork. You're smart enough to make this decision for yourself, versus big investment companies that may prey on people that don't have a whole lot of money and are not smart enough to analyze investments on their own. So that's kind of supposed to be the idea behind it.
Yeah, and also, to be honest, the operators do not like taking investments from people where they're only $20,000 or it's 20 of their $40,000. They just don't want to put themselves in that position because they're responsible ultimately for the investment and how the money's invested. So, Hunter, do you have a question?
Yeah, it was just a question like that kind of answered it, was that it can only go one way. The only reason they're there to protect themselves, right? The PPM, the accredited investor, is only there to protect the syndicate.
Yes, I mean, it depends which way you look at it. So some syndicators like accepting accredited investors only because it actually reduces the liability for the reason that Matt stated. Most of the syndicators I work with now actually accept accredited and non-accredited. So in that case, you can argue they're not really necessarily just trying to maximize their own protection. But then when they're taking non-accredited investors, they actually have the right to ask people on a case-by-case basis their level of experience. And I don't know if they get to the point of asking your investable assets or whatnot, but some of them will want to make sure that they're not taking, your only $20,000. They're concerned about that.
That was my question. So there's one of my friends runs a website that helps people invest in alternative investments online.
Mm-hmm.
And they require them to be accredited investors, but they don't do any background checks as far as they can lie. They just perjure themselves, but how would that ever hurt the person lying?
So when you fill out a form, you're signing it yourself. I've never heard of an operator doing a check to see if someone was accredited. It's actually not their, the onus is not on them to prove that somebody signed and it was actually correct in whatever they wrote. So they're never going to do a check to make sure they're never going to ask somebody for a net worth statement. I've never seen that before. So basically, if you're not accredited and you sign you're accredited, and then let's say something goes wrong with the investment, then I would assume in theory you're still subject to the fact that accredited investors are lower liability and we're expected to know more. So you're definitely shooting yourself in the foot if you're not accredited, you're signing you're accredited. Okay? Yeah, that's the way that I see it. I mean, I'm accredited, so I never really thought of it from that perspective, but I don't recommend anybody to lie.
In addition to that, I mean, I've written, or I've done my own private placement. So on each one of those deals, you have like a private placement memorandum, which is basically like a business plan written out by an attorney. And I can tell you, those attorneys, they write everything in there to protect the operator. I mean, I could have went to Vegas and put it all on black, and then they probably couldn't have done anything to me. I mean, well, there's fraudulent stuff involved, but but at the same time, like, yeah, no, exactly. Yeah, I could go to Vegas and blow it. You can't do this. But I mean,
well, you signed.
Yeah. Hey, sorry. Yeah. But these private placements are, my private placement was 112 pages. Who's going to read this thing? I mean, you got to basically, a lot of people go directly to the risks, and you write, I mean, the attorneys are really thorough. It had like 2 pages of risks, like, I could die and everything's gone, I mean, there's things like that in there to protect the operator from people just suing them over frivolous stuff. It's like, they're just protecting themselves. At the same time, that's why the homework on those deals is so important if you're investing in it, to make sure that you're relying on that operator to help you do that, and you diversify like that, which is a great way to invest, if you ask me. I mean, as soon as I'm done building my wealth, I'm going to start investing passively that way.
Yeah,
so.